My name is Chris Lawton, and I'm Director of Knowledge Exchange here at Farm Credit East. Our presenter today really needs no introduction. I think most of you who have been here for a while or been in the industry for a while know Dr. Hall. Dr. Hall is with Texas A&M University. He is a well-known expert in floriculture and horticulture. He is a professor and Ellison Chair in International Floriculture at Texas A&M, and he is a sought-after speaker nationally and internationally for all types of topics relating to the green industry. He is here today to talk about the industry outlook for 2022 and what's going on in the economy. But go ahead, Charlie.
All right, thank you very much, Chris. I appreciate the invitation to be back. We've had a long-standing partnership. As Chris mentioned, I'm going to be talking about the green industry outlook, and this webinar will kind of build on the article that goes into the magazine that each one of you get in terms of the Outlook magazine. So obviously, 2022 is a big unknown for the green industry. I mean, the last 2 years have been just one of those things where an economist just kind of shakes their head. And all those years where we were growing at 2% rate and everything was quite boring, and we were just hoping for some sort of event to spice things up a little bit. Well, careful what you ask for, right? And so we've seen kind of a mixed bag in terms of the last 2 years. When you talk about the pandemic and what COVID has done for the green industry or to the green industry, it's been mixed. There have been some in which sales and profits have been up significantly. There's some whose working capital is in the best that they've ever been since the history of their business. And yet there are some, there are others, particularly those who focused on the green infrastructure market. And in the Northeast, I know that's a very sizable market, and it's a very important market for growers there in the Northeast, and those that were specializing in green infrastructure projects found they were behind the 8 ball for a little bit because they found that a lot of those shovel-ready projects were put on hold because of the pandemic. So it's been a mixed bag, but by and large, things have been pretty good. Now I want to go through some trends with you in terms of the sales of flower seeds and potted plants. Now, this is data straight out of GDP. And you say, well, where's the shrubs and the trees? Well, that's a good question. This is, again, GDP data. The shrub and tree sales are part of the fixed residential investment numbers of GDP. And some conversations I've had with the Bureau of Economic Analysis folks, they're not going to separate that data out for us easily. And so right now, this is just a proxy. You can see the recessions there in orange back in the early 2000s, and of course the Great Recession. And this is going through 2019. I've got 20 and 21 slides coming up a little bit later, but I want to show you pre-COVID, because certainly when COVID hit the scene, I mean, all bets were off. First of all, we weren't deemed to be essential. And then last year when I was giving this particular webinar, I was amazed at how quickly that we were deemed to be essential, except for states like Michigan, where nobody was essential for a long time. And again, in those areas of the country, it was hard to make up for those March and April sales that were lost. But May was just a gangbuster year. So, it's, again, the mixed effects were there. If you look overall, let's look at GDP, real GDP, that is adjusted for inflation over time. I'm showing right here some data from the Federal Reserve that shows real GDP since 2017. And I've monkeyed with the y-axis a little bit just to show the depth of the decline, but then also the bounce back and then the gradual improvement that we've seen. And of course, now we are close to where we were before the great shutdown, as I'm calling it, before COVID hit. Now, if you look at, if you separate out the 4 components of GDP, you got consumer expenditures, what you and I spend and everybody else. Then you got business related expenditures, those of your own line that are in the business, the nursery business, greenhouse business, the green industry business. Every dollar that you invest as a business, there's a 4-to-1 economic return in terms of those overall multiplier effects of the economic impacts. And then of course there's consumer, business, government expenditures, and then imports and exports. Now, if you back out the import export side of things, and this blue line, which is GDP, becomes gross domestic demand, which is the orange line. And you see, if we back out imports and exports and we take out the effects of that the pandemic has had on this globalized supply chain, then you can see roughly we're back to where we were prior to the Great Recession, just from a domestic standpoint. So I thought that was kind of interesting. What's driving that? Well, you and me and everybody else and what we spend. That's for the first time in a while, it's been in around the 68-69% of GDP is wrapped up in consumer consumption. And of course, we saw almost an 8% increase in 2021. And that bumped us up over 70% of GDP is wrapped up in what consumers spend. And of course, the gross private domestic investment numbers also increased by almost 10%. Government expenditures, not so much, but you can see the big drain on everything was this net exports, where my cursor is over here on the right. Now, obviously, the COVID broke the supply chain, right? And I love this graphic because it shows that, and it's put a lot of pressure. And this is a pressure gauge that that has a lot of metrics here on the left-hand side regarding the supply chain, right? So I don't want you to pay attention to the numbers. I want you to pay attention to the colors, because all these indicators up here reflect how much time it takes to move products through the supply chain. The next set are the volume of movement of those goods through the supply chain, the price or the cost at which we're moving those goods and services, the inventory levels within the industry, the overall manufacturing, production, and distribution industry, and then of course labor, the availability of labor in that sector. And you can see before the pandemic, everything was kind of green. There were some yellow indicators, but over here on the right, you can see a lot of pressure on the supply chain. Now, just from the get-go, one of the take-home messages is that we have a supply chain that we have spent literally 4 decades, since the early 90s in particular, perfecting a just-in-time nature of this supply chain. And you throw a global pandemic on top of this, and because we have globalized and we've outsourced and we've developed the law of comparative advantage, and we've developed this trade between countries and so forth, where everybody's producing the commodities that they have the best comparative advantage at, and free trade agreements and so forth. This global pandemic kind of puts a wrinkle in this globalized supply chain. So it's no wonder that it's taking us a long time for those wrinkles to iron out, and it's not done yet. In fact, one of the other take-home messages is that it's basically going to be the end of the year before we see market improvement in the supply chain from a supply chain perspective. And that many of the containers that are still off of LA and Long Beach and Savannah and Charleston and so forth on the East Coast, those are still out there. There's fewer of them, but there's still, I think there were 60 different ships, I think, outside the Charleston port the other day. So, I mean, on both sides of the coast, we're trying to bring in product as much as we can, but then a lot of folks are trying to de-risk in the supply chain, and they're using the trucking industry in which to move products as quickly as possible. They're bypassing some of the other intermodal avenues like rail, and so rail usage, I think, declined, I think it's 7% last year, whereas the truckload and less than truckload shipments were up quite a bit. So now you have that demand for the trucking, and you got fewer workers in the trucking side, because a lot of trucks, like truck drivers, say, you know what, I don't need this crap. I'm dealing with COVID. a lot of the trucking that goes on is with team drivers because of the regulatory aspects on the trucking industry and the number of hours that drivers can drive. So now you have to team up, and some were vaccinated, some weren't vaccinated, so it was harder to team up drivers. Driving schools were closed during COVID, so we had the supply of drivers dry up, and we went from a situation of being 46,000 drivers short to 80,000 drivers short. And the ATA, the American Trucking Association, says with the tonnage that we're expecting between now and 2025, we'll be back where we were a few years ago when we were 100,000 drivers short. So we've gone 2 steps forward and 2 steps back, and roughly where we were about 6 years ago. So it's not a good thing. There's a lot of demand. We're going to see freight rates continue to increase, and that's going to be a part of life until 2025. We're not going to see a lot of relief there, and of course there's a push to bring on more truck drivers, but it's going to be a little while. Now, not just truck drivers, it's labor in general. This great reevaluation, the great resignation, you've seen those 2 monikers in the mass media and talking about how difficult it is to find labor. And every green industry firm, here you got a landscape firm, lawn maintenance firm that now hiring, right? That's a common sign throughout the green industry, but not just the green industry, it's all industries. And this graph here is a survey that was conducted back in 21, and they were asking folks, are you going to go back to the job that you had before? And 31% of them said, no way, not at the same hours and the same pay. And so we've seen a number of folks, you see as the job openings, this is the JOLTS report, it's the job openings and labor turnover. It's you can see the blue line there is job openings. The red line is layoffs. We didn't have a lot of layoffs right there in the midst of the pandemic, and that's still going down. But look, the light blue line is the number of people quitting their job. And the reason for that is that, like I said earlier, that they're looking for something better, either in terms of hours worked, in terms of maybe a split appointment of working at home, working in place, or looking for higher wages, or all the above, right? So it's a labor situation that continues. And right now, when you ask who's missing from the labor force, if you compare relative to 2019, 33 or almost 34% of the workforce were men 25 to 54. Well, and women made up roughly 30% of the workforce. Well, right now, fast forward to today, and you see the bar there on the right, 34% of those who are still missing are women, not going back into the workforce. Dual responsibilities, child care, not only child care, but child teaching, because the schools haven't been open consistently and so forth. The other big component here is that folks 65 and older, who only made up 7% of the workforce prior to COVID, but then 23% of them are still out. And that's because we've had about 1.5 million to 2 million excess retirements over the last 2 years. COVID has caused this mind shift in terms of retirees. I'm just going to take early retirement. The heck with this. I don't need it. Now, interestingly, this is not, I mean, some of these folks, particularly the younger folks right here, they've if you look at the number of business startups during over the last decade, you can see relatively constant around 200,000 applications for new businesses for a while. It increased up until 2019, and we were just knocking on the door of 300,000. But look, during the pandemic, the spike in the number of business applications during the pandemic. This is part of that great reevaluation. Folks are saying, look, I'm tired of this, and I'm not convinced that going back to the same job is worth it, particularly those in the leisure and hospitality industry. And it was hard enough it was, and now you throw COVID in, and we've got masking or no masking, or vaccination or no vaccination, all this divisiveness. Folks said, forget it, I'm starting my own business. I've always dreamed of doing X, Y, Z. So by golly, I'm going to do X, Y, Z. And so that's kind of interesting that a number of folks that are not in the market right now in terms of the labor force opening their own business. Now, we do know that not all those folks are going to survive. You know, a third of businesses are going to fail within the first 5 years, roughly, right? As we've seen historically. So there's going to be several of these folks that re-enter the job market, but it's not going to be tomorrow, right? Now, there have been some stimulative policies like the American Rescue Plan, and before that plan was put in place in March, February last year, unemployment was 6.3%. The Congressional Budget Office was estimating it'd be 2023 before we got down to 4.6%. A la enter the American Rescue Plan, you put money into different sectors and creating jobs. 6.6 million jobs were created. Unemployment's 4%, 2 years ahead schedule, right? So, and until the last couple of weeks, you had the stock market at record highs. Now, we thought they were at record highs during the Obama administration. Then the Trump administration, the stock market continued its growth, right? And so we've seen this even during the Biden administration. We've seen the stock market continue to grow. Was it Obama? Was it Trump? Or was it Biden that's responsible for that? No, it's expectations in terms of future opportunities and future risk that drives the stock market. So that's what you're seeing. And up until, like I said, in the last couple of weeks, that's gone down. Now, there's been some wage pressure, and you can see that in the employment cost index. Ever since 2015, roughly, we've seen this increasing on the employment cost index. And of course, that's all non-farm jobs. I'm talking about non-farm jobs at the moment. But that's a significant increase that we've seen over the last 5 years, and it spiked. We got a new growth rate during the pandemic. But look, when I look historically here, and this is data from the Bureau of Labor Statistics, and you look at where we were back in just right at the end of the Reagan years, you can see the employment cost index, you fit a regression line through there, it's gone down, 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 down. Wages, right, have gone down from a cost of living standpoint since 1984, right up until the 2014, 2015, and now we're seeing the big catch up. This is what I'm calling this. This is the great catch up, and a lot of the wage pressure that we're seeing right now. And I know a lot of folks in the green industry and all industries are lamenting these wage increases. Yes, they've come too fast, too quickly, but this is the big catch up in terms of wages. And this downward pressure that we saw for decades before then, now we're seeing that wage turn around. It's a shift in terms of the employment cost. All right, and again, here's another picture of how that employment cost index has increased. But let's go to ag workers. This is data from the Farm Labor Survey, which the USDA NASS, National Ag Statistics Service, collects every April and every November. All right, in the November report, field workers across field and livestock operations average $15.77 an hour. And you've heard all the rhetoric in the media. A lot of folks raising Cain about the minimum wage of $15. We're already there in agriculture. $15 would be a wage decrease. All right, so we're already there. And you can see that you fit a regression line through here, and there's one set of data until long about 2019. Right, you see a new a steeper curve starting, a steeper trend there. And a lot of that has to do because the H-2A rate is tied to the Farmer Labor Survey. And there's been a movement afoot. There's a movement afoot right now. USDA is asking for comments about whether to tie the H-2A rate to the employment cost index, which would be, roughly 2 to 3% growth in that employment cost index each year, instead of the 7% growth that we've seen in the past few years. In some states, we saw 23% increase in H-2A labor rates. So That's, again, for the farm situation, the steeper increase in terms of those labor rates than labor at large. And of course, we talk about inflation. And we ask the question here, is this inflationary pressure that we're seeing a cost plus pressure? Is it a wage plus pressure, or a cost push, excuse me, not plus, but cost push pressure, or a wage push pressure, or a demand pull pressure? Yeah, which one of those is causing this inflationary time period? The answer is yes, all of the above. Right? It's not one single thing. There's the wage pressures that's caused from the Great Reevaluation. There's the cost push pressures from the supply chain and the difficulty in getting inputs, and the overall price increases that we've seen in terms of goods at large, both durable goods and non-durable goods. And quite frankly, you see some firms that see the opportunity to raise prices, and they're taking that opportunity. So there's some of all of this. Now, this is another dashboard. It's consumer related, and you can see that it's how red it is right at the first of the pandemic, and it was getting better. And in March of 21, a lot of the indicators were green again. These are fast-moving consumer related indicators. The previous ones were the supply chain. These are consumer. And you see it was getting better. And then what hit? Delta, and then Omicron, right? So we see retail sales really increasing. Now, if there's one chart that I think really, really demonstrates the inflationary pressures that we're seeing, this is it. Because you can see that since February of 2020, in the 21 months since, in October 2021, we had a 21.4% increase, right, in retail sales. So you put the CARES Act, you put the child tax credit, you put the COVID relief program, you put all that money into stimulative policy, you put it in the pocket of homeowners, expenditures rise to meet income. So what did we do? We spent it. We saved some of it, but we spent the majority of it. And retail sales increased 21.4%. Now, just to put that in perspective, at the beginning of the Great Recession and the dip in retail sales, it took us 9 years for retail sales to increase 21.4% from what it was prior to the Great Recession. Just following that trend, it took us 9 years to grow 21.4%. And here it is, this data is showing we've grown retail sales 21.4% in 21 months. And then you have the audacity to ask, where's the inflationary pressure coming from? This is the demand pull side of it. The supply side is the cost push. That's the supply chain side. The increase in wages is the wage push. So this inflationary pressure is not any one particular event. It's a perfect storm of all these things. Just like the Great Recession was the perfect storm of housing bubble burst in the middle of a financial crisis. This is the perfect storm in the other way, right? So this is why we're seeing that inflationary pressure. And you can see this spike in terms of the PCE index, which the Fed uses in terms of deciding whether it's going to raise interest rates. That's that 2% target that they have historically used. And when PCE was above the 2% target, they would start ratcheting up interest rates. But they elected to go to a range, and I've yet to see Jay Powell or others define exactly what that range is yet, but certainly we're above whatever range in terms of raising interest rates, and that's why you're going to see it. And before I get there talking about interest rates, let me just show you the differences in the inflation by type of product, right? So gasoline, used cars, hotel motels, natural gas, a lot of those are, really increasing. The gasoline mainly because of geopolitical events like Russia. Russia is a big part of the oil industry globally, and when they start mucking around with the geopolitics, it affects the oil market. So that's what we're seeing right now. And you can see it goes all the way down to health goods, health-related goods. that didn't increase very much at all. Now, this is what I was talking about in terms of oil, but the good news is that ceteris paribus, provided that Russia doesn't, they've done this partial invasion already when they took certain pieces of the Ukraine and recognized them as independent states yesterday. But this geopolitical, if as long as Russia doesn't completely invade Ukraine and we go out all out, sanctions and war, etc. Right now, the Energy Information Agency for diesel is projecting an increase from last year's 329 per gallon to 333. Not a significant increase. Even on regular gasoline, you go from 3.02 per gallon to $3.06. That's the national average, and not a huge increase in terms of natural gas either. The biggest increase, of course, is in electricity. All right, so that's coming down the pike right there. Now, I know I've got interest rates. I almost started down the interest rate path, but one of the reasons I'll hit it for interest rates, I want to talk about housing first, is because a lot of the demand for housing is going to be impacted by this rise in interest rates we're about ready to see. So there's been demand from the high wage workers who said, if I go at the shelter in place and work from home, and some of them are still working from home, I might as well have a home at the beach. So they've upgraded their homes. Plus, you've got the millennial wave. Remember when we told the disparaging remarks we made about millennials and entitlement and so forth? Well, you're going to have to take it back, because millennials are 38% of home purchases right now. By 2025, millennials are going to be, I think saw the estimate was like 70 to 75% of the workforce. So that's just a few years down the road, right? So you've got some things that are going to be happening, and millennials are responsible for that. But what we see, housing prices, the U.S. average, this is the Case-Shiller Index, this is the U.S. average, 17.5% increase year over year in terms of the appreciation of homes. You can see it varies by region of the country. The mountain areas, 23% year over year increase. Other areas, not so much. But in the East, North, Central, 14%, New England, 15.4%, where y'all are listening right now. So you didn't have quite as high appreciation on your homes as what the national average was, but still it's double digits. So it's something to keep in mind. I'm watching this pretty closely because if you look at the nominal prices and the Case-Shiller Index for the national index, this is the blue line, you can see this is where we are right now. The left-hand chart, the right side of it, where my cursor is, there's the blue line. You can see that blue line is a lot higher than where housing prices were before they burst, for the bubble burst before the Great Recession. So in nominal terms, we're 18.8% above for the year over year, but we're even more so above where we were prior to the Great Recession. Now, that looks really bad. We've got a bubble forming right there. But when you go over here to the right-hand side, and you can see the blue line, you adjust for inflation, right? So the real prices of housing right now are only is 0.7% year over year. We're right about where we were when the bubble burst. But the difference is that now I told you millennials are 38% of the market. So millennials are going to be continuing to buy more and more. That percentage is going to increase. There's 84 million millennials compared to 78 million boomers. So we're going to see the demand for the demographic changes that we've got upcoming. We'll see the demand for housing increase. So I don't know that we're in a bubble yet. We continue along this path that will form a bubble. But right now, we're just satisfying demand, and we'd do it a lot quicker if we could get windows and refrigerators and shingles and a lot of other things to build houses. Now, let's talk about interest rates. Obviously, interest rates are going to start rising because the Federal Reserve has a twofold mission: to provide an environment to facilitate full employment. Number two, to mitigate any inflationary impacts, right? So We don't like inflation, and right now we've got that inflation occurring. So if you look at where the federal funds rate is likely to be, myself, and I know you got some other experts online that are quite accustomed to thinking in terms of these interest rates, but my humble opinion is that we'll likely see the FOMC announce a 25 basis point increase in March. I think they'll follow that with a 25 basis points in May. Then I think before the summer, they'll come in with another 25 basis point increase in June. So that'll be 75 basis points this spring. And then they'll see how that settles out in the summer. I think they'll come right back, and depending on, that's not going to be enough, I don't think. So they'll come back in September, and I think they'll raise it another 25 basis points, and then maybe even December, come back with another 25. And then next year, remember 2023 was when they projected to start raising rates. They're going to take a rather aggressive move because everybody's feeling a little pressure. Particularly, they are feeling a little pressure about this 7% inflation that we saw last year. So they're going to move quickly. They're going to move aggressively and try to nip this thing in the bud. So you got to do this gradually, though, and then we'll see another 2023, another probably 25 basis points each quarter for the first 3 quarters next year, and I think we'll be where we need to be at that point. So you're just talking. A 1.75 increase between now and then. So it's not going to be, I mean, you already have dirt cheap money. So it's not as though that's going to raise the rates so high that you can't afford to make strategic investments in your business. So it's right now, as you'll hear me say in a minute, the working capital is pretty good in the industry, and folks have used that working capital to either pay down debt or extract some dividends. The second bucket that they've used that the working capital for from PPP, the USDA COVID relief monies and so forth, they're using this working capital to pay down debt, invest in CapEx, and then thirdly, invest in tradable assets, that is build inventory. And I see a mix going around the industry, but I think we're going to see some inventory build that's going to be significant. So what are those rates going to do to future economic growth? Holding all of the things constant, the leading economic index points out to fairly good growth over the next 12 months if things hold constant. But again, we got to get, it looks like we're going to get past Omicron, but how many more variants are there, and how steep of a climb are they going to, an increase in cases and hospitalizations and deaths are they going to cause? We don't know that, so there's a certain degree of uncertainty. But projected right now, if you look at GDP growth, 2021, right around 6%, what's projected, ceteris paribus, holding all other things constant for 2022, is another really strong year of growth, 5.2%, because we're still rebounding from this supply chain, and as more durable goods purchases start occurring, more non-durable goods purchases start occurring, as we buy more services, particularly face-to-face related services, that's going to be pretty good. And then we'll settle out from there. We'll head back to trend, even slightly below trend, because you can't have this kind of growth indefinitely. This is it. You heard a lot of politicians over the last 30 years promise 5 or 6% annual growth in GDP, and it never happened, right? We're always in this 2 to 3% range roughly, and the 3 was the max, right? So we'd always see in that range. It took a pandemic and a recovery from a pandemic, global pandemic, in order to cause this kind of growth. And of course, the U.S. has grown a lot faster than many other sectors. Now, checking my time, 10:36, we're right on target. I got about 8 minutes, and then we'll open it up for Q&A. I had this slide last year. I just brought it back. I'm not going to go through this. Labor is still critical. Shrink is still critical. There's been less discounting going on, and as far as growers have been able to raise prices, and some of them have been double-digit and significant double-digit price increases. And that's a good thing because my index of prices paid by growers, this is my 2007. If you say 2007 is 100, and then you take all the inputs that growers use, containers, media, propagated materials, labor, freight, and you weight them by the relative importance, what percent of cost of goods sold they represent, then this gives the index, and I have a econometric model for each one of these. I took out some of the years just so that this is the last 5 years, right? And so this is my estimate for 2021. I came into the year expecting roughly about 7% increase in the cost of inputs for growers. It turns out it was closer to 9.9% when it's all said and done. And what I'm projecting this year is another 4.7% increase in the cost of these inputs for growers. So again, those growers that have increased their price 10 to 15%, they're covering the most, if not all, of their cost increases. Those that have increased prices more than that are going to be in a better position. But the key question is, what's it going to do at the retail level? And I pulled this slide out of last year's webinar and brought it back because when I said last year that traffic count and dollars per transaction were up over 2021 over 2020, 2020 over 2019, the same was true in 2021, that traffic count, transaction, dollars per transaction was up, the overall gross sales were up, and there's one more metric. Whatever it is, every retail metric was up by and large. It varied by region of the country, but it was still up. So that in 2020, here's my chart. I told you I'd show you the 2020 data. 2020 was a lot better than 2019. And then when you add 2021 here, the yellow, the orange and the blue is simply demarcating the years, going from 16, 17, 18, 19, 2020. Look at 2021. I fit another regression line through these data. And in 2021, every month, right, of flowers, seeds, and potted plants, every month was higher than 2020. When you add in the shrubs and the trees, and I have data from the Garden Center group that Danny Summers shares with me. Thank you, Danny. Big shout out there. I have data from the Ian Baldwin and his 5 Numbers project, which is part of my Your Market Metrics program as well. And thank you, Ian, for sharing those numbers. All the months last year were good. It's just that the summer months, June, July, August, were not quite as good in 21 as they were in 2020. But for flower, seeds, and potted plants, they were. All right, closing thoughts. We obviously are going to, we're still having a situation of undersupply of houses. There's pent-up demand. Millennials are driving this thing, the 38% of purchases. It's going to be 2023 or 2024 before we see any sort of housing market correction, in my mind. We are going to see some more business acquisitions and closures. Anytime you have either a shakeup where you have profits that are either greatly diminished or profits that are greatly increased, you always see a lot of business acquisition and closure activity, particularly acquisition. And I get a lot of calls from a lot of venture capitalists looking to spread that black powder across the industry. And I don't necessarily talk to them at all, but just the fact that I'm getting so many calls means that they're interested in our industry again. There's this constrained and supply chain is going to continue, like I said, until the end of the year. There's going to be some de-risking of that supply chain. A lot of the things we outsource to different countries, we're going to insource or bring those closer to us. That comes at a cost. And you see, you've heard about the microchip plants that are going to be put in, billions of dollars of investment so that we don't run out of computer chips like we did this time, because everything is backed up because we don't have enough computer chips. So this de-risking of the supply chain is going to go on. There are going to be more B2B and B2C technologies adopted throughout the supply chain for transparency purposes and to make it easier to do business than what we've seen in the past. Working capital is good. I said that. But shrink, labor, and freight costs are still critical points there in terms of managing growing retail and service businesses, right? Those are the trifecta in terms of the bottom line profits. We're going to see higher healthcare related costs in the future. COVID's not behind us just yet. We're going to see the rising input costs, like I said, but that year-over-year increase is going to slow down, right? So we're already starting to see a little bit of slowing in terms of those input cost increases. So they're going to increase, but it's going to slow down. Lastly, remember I said that most people are putting that working capital into either paying down long-term debt, investing in CapEx, and or building tradable assets. And I've seen a number of growers doing all three of those. But I know, so I grew up in this industry, and every time that we've seen this kind of demand build up and the price increases, we see a response on the part of the growing sector where they lay down some new gravel, some new irrigation, they build some more greenhouse space, and we're going to see some plant shortages turning into surpluses. And we call that the bullwhip effect economically, where it's like cracking when Indiana Jones cracks his whip, that comes up and then that goes down slowly. It's the pig and the python effect. So we're going to see a buildup in inventory, and that's going to work its way through the system. The question is, what kind of pressure is that going to have on consumption? And that's the one question I can't answer. Is the consumer, remember this regression line of consumer purchasing, are they going to continue increasing their lawn and garden purchases, their landscape service purchases at the same rate as they have in 2020 and 2021? I can't answer that. I know there's some positive data that I mean, if you look at GDP growth this year, we should see, and there's some data from different surveys, like people spending more time gardening. They say in 2022, the Axiom Marketing Survey, consumers say they're going to plant more, 62% of them. Millennials are driving that growth in terms of what they plan to spend money on in 2022. They're going to spend it on flowers, vegetables, house plants, perennials, containers, in that order that you see there. Most of them felt successful, and that's a main driver in terms of lawn and garden consumption, as well as their interest in gardening and outdoor activities. And you can see over here, the vast majority of millennials and 60% of all people at large said that their interest in gardening and outdoor living activities increased because of COVID. So, I mean, there is some good news. 92% spent the same or more in 2021 due to COVID. When you look at the things that they're going to spend money on, things that lower their stress level, things they can do with their family outdoors, creating beautiful outdoor space, outdoor entertaining. All of these things in this chart right here have to do with our industry, the green industry. And obviously 28% of those folks say they plan to spend more in 2022, right? And if money was no object, they'd increase their garden size, they'd have more flowers and vegetables, they put in a pool, a deck, and so forth, but have an outdoor kitchen and so forth. They may even put in their own greenhouse. But what I'm saying here is that a lot of those outdoor projects are very related to what we do. As I said, millennials are driving this thing. They're going to be 25% of the population is going to be millennials by 2025, and then 75% are going to be the workforce. So they got a lot of spending power. And fortunately, they love us. 38% of them are buying houses. They're buying things that improve their lives, like I got highlighted right there. This has got us written all over it for the green industry, right? Just like I was talking about. So what's the bottom line? there are things that matter, right? Inflation matters. The supply chain matters. Whether there's a number of trucks that we need, the number of containers that we need, right? The carts, right? Those things that matter. But then there's another circle of things you can control. And it's the intersection of those that I think you need to focus on and not necessarily worry too much about what's happening out here and the things that matter that you can't control. So to me, this is a good time. This is a good time within the green industry. I've said the phrase all spring that the hay's out there. It's time to make hay. And we're in the best working capital position that we've ever been. We've got some strong consumer demand that should be, unless Mother Nature doesn't cooperate with us, we should see that consumer demand be similar to what it was in 2021. I'm projecting that. I told you on the slide before, I can't tell you for sure, but all I can take is look at the data, the survey data, and at least the stated preferences that they say that they're going to do during those surveys point to us having another good spring. Time will tell. All right, so we'll see how this plays out.
Okay, thanks a lot, Dr. Hall. Really appreciate it. We have a few questions that have come in. Just a reminder for those of you who would like to ask questions, just open the GoToWebinar control panel on the side of your screen and type your question into the Q&A box, and we will ask it of Dr. Hall. So one question that came in is a great one, actually, related to inventory build. It says, historically, inventory build has not been correlated with positive earnings at the individual business level in the green industry. As we see inventory builds throughout the industry, what are your thoughts on prospects for net earnings for this industry?
Yeah, if you look at net income over 2020 over 2019 and 2021 over 2020, it's been positive each year. And the growth in net income. Now, this is bottom line net income. Same way with operating profit or EBIT or EBITDA, whichever language you speak in terms of profitability, those have been increasing since 2019. And how do I know that? Because in the database that I have called Your Market Metrics, I got 63 growers in this financial database where I collect income statements and balance sheets, $2.3 billion worth of sales represented by these 63 growers. So it's a good proxy for the overall industry. And I think year over year, net profits increased just less than double digits from 2020 over 2019, more than double digits in 2021 over 2020. So again, because the PPP monies and the USDA monies, those were shot in the arms for a lot of businesses. It aided their cash flow. And that's why I'm saying that working capital is the best that I've seen it. And in every single situation, you go back to 1984 after the 83 freeze. I saw it in 1990 after the 89 freeze along the eastern seaboard. But that's when we saw real price increases and net profitability increase so much in the industry. In every single circumstance, I saw some growers paying down long-term debt, some growers investing more in CapEx, and some growers building tradable assets and building inventory. And I see an equal amount of all that going on right now. So I know that there's going to be a buildup in inventory. Now, and I also talked about some of the acquisition opportunities, and some of that productive capacity is not necessarily going to leave. It's just going to be under a different shingle. So we're going to see those kinds of things happening, but we're going to see an inventory build. It's going to take longer for shrubs and trees, obviously, and it's easier to take bedding plants. Man, with the box store market, you can push a lot of bedding plants, and that's the number one product that consumers can afford is bedding plants. So even if we see some sort of housing correction, people are still going to invest in those smaller in-house plants and succulents, and you got bedding plants and so forth. They're going to buy that. But some of those shrubs and trees, particularly larger trees, that's when they start cutting back. We're not there yet. But and so I've talked to some growers in the last 2 months that were building their inventory of 45-gallon trees and bigger. So I mean, there's going to be and you can't just move a 45-gallon tree when things start getting tight economically. So we're going to see that inventory build. So I'm just cautioning growers, when you consider those 3 buckets, think strategically in terms of how you allocate paying down long-term debt and how you're investing in CapEx, which most of them have been using. They've been expensing those assets. They haven't been borrowing as much money for that CapEx. That uses up some of that working capital. So I tell them there's a trade-off there between using that working capital for paying down debt or CapEx or building assets. There's that trade-off, and how much retained earnings do you need to have as a reserve to buffer the next downturn? Well, I can't answer that for every business. It's a different financial situation for every business, and there's different willingnesses to embrace risk on the part of every business that's out there in the green industry. So those risk preference curves are different for every single business owner and operator. So there's a lot of moving parts here, but it's going to make the next couple of years very interesting compared to 10 years ago when we were just growing at 2% and so forth, and it's kind of boring.
Thank you. I know that you're in Texas and you often look at national markets and trends and so forth, but I know that you also track the various parts of the country. In the Northeast, things are often a little different than the rest of the country. For one thing, we're largely built out on a residential basis. We don't have big subdivisions the way they do in the West or South. Any trends that you're noticing in the Northeast corner of the country that might be different or varying from national trends?
Yeah, in fact, the Northeast, if you look at it as a whole, from a retail standpoint, retail garden center sales have been really strong in the Northeast. They've not been as strong as what's been along the southern tier, both the Southeast and the Southwest, but they've been double-digit growth in 2020 and 2021. And a lot of the retailers are in a much better working capital position than what they've historically been as well. So I think that's a good thing, and because they're going to need that. I mentioned the price increases that we're seeing, and I don't regionalize my index of prices paid index. That's a national index, but just looking anecdotally, there's some of the price increases on some of those inputs are increasing in the Northeast a little bit faster than other parts of the country. So there's going to be that need to increase price, maybe even a point or two above what I was talking about earlier. And right now, the retailers should be able to handle that because they've got the cash flow to handle that as well. So, but at the point, there's got to be some point though that we price ourselves above what the consumer's willing to pay. We don't know what that inelasticity of demand really is, and that's why I've been saying to folks, you got to talk about those plant benefits. It's not just about the aesthetics; it's about health and well-being benefits, and it's a perfect time for us to do that because this is a health-related crisis that we just, I like to say we came through like it's past tense, right? But we're almost there. See the light at the end of the tunnel. But if we emphasize the health and well-being benefits, then that'll increase that inelasticity of demand, so we can raise price. And even if we sell fewer units, total revenue for the firm, in this case, the garden center, will go up. So we've got a lot of work ahead of us, and we can't be complacent that the consumer is going to be there, because we need to talk about these functional benefits. And last year, over the last 2 years, I've had interviews by the Times, the Post, the Tribune, the Wall Street Journal, Marketplace, Kai Risdall from Marketplace. I mean, a lot of people I've had interviews with. Why aren't people gardening and landscaping more? And that's when I've had a chance to talk about these health and well-being benefits, which I think as an industry we need to continue talking about, as well as in the Northeast, the green infrastructure market is stronger than any other part of the country. There are more businesses that are introducing green roofs and building in green walls. As you look at architecture nationwide, the Northeast is leading in this. So I think there's tremendous opportunity in the green infrastructure market there in the Northeast, and you've got some growers that are positioned to take good advantage of that.
One of the segments that's been kind of on fire during the COVID pandemic has been tropicals and houseplants, and sales have been really increasing double-digit percentages. Do you think that that's a trend that's going to continue to stay strong, or do you see that as a bubble that's going to sort of burst when we come out of our houses, I guess, again?
Yeah, at some point that bubble will burst. But I'm not saying it in terms of taste and preferences. I'm speaking demographics, because what's been driving that demand has been millennials, and that's been their foray into the gardening and landscaping years. Before they had the money to buy their first home, to landscape their first home, they bought succulents, they bought houseplants, and so you got a lot of people. And there's a bunch of millennials that are still coming through the pipeline. So I don't think we've seen the death of the houseplant industry like you've seen a couple of folks talk about in the trade media, but that's going to continue. But you got to remember that our birth rates, Gen Z is fewer in number than the millennials. So we get the next boom. The millennial generation is just now hitting the gardening and landscaping years. The next 20 years should be really good. It's 2045 that I worry about because of the declining birth rates. I get 20 years down the road, and I'm really concerned because, first of all, with our declining birth rates, and you got fewer people, you got labor force participation right around 62, 63, 65% or whatever. So you need number of people working. Productivity has been kind of stagnant. So you need more people, and you can't build walls and have more people. So a lot of it's really, do we have comprehensive immigration reform in there? And are we going to have more people in this country? And it's the same with housing, right? 20 years from now for housing, I'm not that optimistic either. But for the next 10 years, oh man, Katie, bar the door. And all those houses need flower shrubs and trees around them.
A question, or I guess more of a comment, somewhat agreeing with what you said in your previous answer. At a wholesale level, we're seeing increases anywhere from 15 to 18% or more on evergreens, large landscape-sized shrubs, and things like that. Retailers and wholesalers typically are going to pass along these price increases. Do you see consumers pushing back, and at what point do you think it's going to be too much and start to hurt sales and pricing?
Yeah, that's the magic question. Yeah, at some point they will push back, but we don't know what the point that is because we've never tested that inelasticity of demand to its fullest. We've had 3, 4, 5% price increases, but we've never instituted price increases like this in a span of 2 years. This is unprecedented. We've never done this in the green industry since I grew up in it in the late 70s. Well, I've never seen price increase this dramatically in this short a period of time. So we're going to hit it. I just don't know at what point. Right? So there will be a point, particularly for starter consumers, right? Those just entering into the gardening and landscaping market. We're going to outprice ourselves for those. So we're going to have to think about what are the SKUs that we can price at the entry level point, and the SKUs that we can price at the higher price point and cross subsidize within that mix of SKUs at the retail level. And I don't know that we're really looking at that yet in the industry. We're just trying to capture the opportunity at the moment.
Great. I guess we're at the top of the hour. So to wrap up, I'll ask you one more question, Charlie. So looking to the next, say, year or 2 years, what do you see as the limiting factor for the green industry? Do you think it's going to be consumer demand, people willing to buy the products at the prices that we're charging? Do you think it's going to be labor and productive capacity? Trucking? What do you see as what's going to hold us back?
Yeah, the main headwinds, again, labor is you ask any grower out there, that's the first thing that comes out of their mouth. It's labor availability. The question is do we really have a labor availability issue, or do we have a wage issue? And again, I think our industry is going through the big catch up because we've notoriously had low wages in our industry for the past 4 decades. And horticulture has never been known for its high wage levels. And so I think we're seeing that ratcheting in terms of wages. That'll help drive some folks coming to our industry. It's supply and demand. And then trucking is another big headwind because we're not going to see any relief in those freight rates until we got the tonnage expectations between now and 2025. There's just no relief in sight. So it's going to be a matter of how you manage those logistics and your capabilities. And then thirdly is that the supply chain, at least over this year, we're going to see the supply chain, the number of trucks and truck drivers is a big headwind. And so we're going to have to get through that. And the firms that use software and other tools that have good connections within the trucking industry are those that are going to have an advantage in the marketplace. The consumer, I'm not too worried about the consumer yet, but again, I just don't know where we're going to reach that point of the maximizing that inelasticity demand.
Great. So let me make a couple of wrap-up comments, and then I'll ask you for some final thoughts, Charlie.
Sure.
This webinar has been recorded. It will be posted to our webinars page on our website. That's farmcrediteast.com/webinars. That's where all our webinars live, past, present, and future. So you can find future webinars that are as we announce them, as well as recordings of archived presentations. I encourage you to check out farmcrediteast.com and the Knowledge Exchange pages on farmcrediteast.com. There's a lot of resources there. Dr. Hall, just to sum up, so how are you feeling about the green industry going into the end of the year? You bullish, bearish, optimistic, worried?
Oh, I am. I'm bullish because that closing slide I had of the hay's out there. We got to make hay. Now, whether or not it rains before we can make hay, that's another question. But right now, I think the opportunity is there. But Christic, the opportunity is always there. A lot of people call me Professor Silver Lining, but I've seen people make money in the midst of crisis before. And so I think it goes back to that Venn diagram, those 2 circles. Focus on the things that matter that you can control, and you can control how you handle your working capital. You can control the wages that you pay. You can control the truck drivers that you entice to come and pull your loads and so forth. There's a lot of things you can control, and there's a lot of messaging, consumer messaging that we can control. And I think if we do that, then I think times are going to be really good.
With that, we will sign off and wrap up. Thank you very much, Dr. Hall. Thank you, the audience. And with that, we'll adjourn.